All right, that's a couple of views coming in from Wall Street, but the big view here on Breakfast with Profit is Marc Faber, a special guest joining us to help us understand his view on the equity markets. And yes, he's living up to his name of Dr. Doom and giving us a sense of the bearish sentiment out there. Mr. Faber, thanks so much for joining us. Good to get you here on NDTV Profit. Let me just first start by asking you for your take on the equity markets right now. We seem to be in a consolidation phase. You saying that this could turn into a real correction led by currencies, actually.
Yes, first of all, I don't think one should only look at indices, but very clearly a lot of stocks are today no higher than they were in May, like the oil shares. Resource stocks are by and large down from the peak in May, June of this year. So some correction has been underway already, and also in global markets we have corrections, like China is now down almost 20% from the peak and is no higher than in June. So I think that after this huge run-up in stock prices we had between March 6th, which was the low for the S&P 500, and June, since then the market has continued to go up. But the big move was between March and June, 43%, and after that we just went up 7%. I'd also like to point out that the euro has been trading in a very narrow range against the US dollar. Since June, we are at the same level, essentially around 143. And I believe in the next 10 days to 2 weeks, we'll get big moves in markets. And I wouldn't be surprised if the dollar would, for a change, strengthen, and equity markets would correct, and possibly quite meaningfully so.
Dr. Faber, but what exactly is the rationale behind this call that you're giving us on the dollar and hence the equity markets? What's changed now that you're compelled to make this change in your directional call?
We had a tremendous rally in equities from the March lows to around the June 15. And after that, equity markets continued to go up, but at a much slower rate. In other words, between March and June in the U.S., we went up by 43%, and since then we're up another 7%. In other words, the rate of increase has diminished. At the same time, the U.S. dollar, which was very weak between the end of February and June of this year, has traded in a very narrow range against the euro up to this very date. Up to this very date, from June, we are flat against the euro, despite of the fact that there have been a lot of negative comments about the US dollar and so forth. Now what we have is extreme optimism among investors and economists about the outlook for the economy and about the stock market, and extreme pessimism about the US dollar. And therefore, for the next 4 weeks or even 3 months, it's possible that equities will disappoint, that the correction that is going to happen is more severe than is anticipated, and some markets have already corrected by 20%, like China, and some stocks are already down by 10, 15, 20%, and that at the same time the US dollar rebounds somewhat.
Dr. Faber, it's also surprising that the markets are actually correcting when fundamentals are actually looking a lot better now. How do fundamentals actually compare to the recent run-up that we've seen in equity markets?
Well, in general, I think that the fundamentals are, of course, still very poor. They are somewhat better than at the trough of the economy in March, April of this year. But in terms of private sector economic activity, we're still down in most sectors by about 20% from the peak 18 months ago. So there has been some improvement, but from a very low level.
Dr. Faber, also the biggest concern right now for global equity markets somewhere seems to be China. How concerned are you about this China factor and the correction that we are seeing in China?
Well, basically, we had bank loans rising at about the 30% annual rate. And because we have excess capacities in China, no new factories need to be built. So so the excess liquidity that was injected by the government, and don't forget the Chinese stimulus packages, are as a percent of the economy the largest in the world. Most of that money then went into speculation, into properties and into equities. But obviously you can't increase your lending by 30% annually, or you can't increase it at an accelerating rate. Even if you just increase it at 30%, the stimulus from this increase then gets lost. So I think that under whatever conditions, the Chinese market was due for a correction, and this we have now, and I think it may still run for a while.
Talking about the rest of Asia, Dr. Faber, what is your call on India right now? Fundamentally, we seem to be holding steady. We had GDP numbers 6.1%, not bad at all. What do you make of the stock markets, though?
Well, I think the market is fully priced, and I would take GDP figures in every country of the world with a grain of salt. I don't think that the Indian economy is growing at 6% per annum, but it may be growing at 3% per annum, which is still better than a contracting economy. But I think that the market, having risen from essentially less than 7,000 in last October, now 7,700 at 16,000, we're probably quite fully priced.
So you would go short on India now, Dr. Faber, at this stage and these levels?
Let's put it this way. If you put a gun on my head today and say either you have to go long India or short India, I would short the market right here. But that is not a long-term view. It's a view that I would revise in a month or so. But I think the market will come down from this level.
And of course, Dr. Faber, that's a call on the broader markets. But what sectors actually look attractive to you in India right now? If you had to tie up additional capital, what sectors would you put that money into?
Well, I'm not a specialist on individual shares in India. But in general, I like agriculture, whereby now we have a monsoon problem in India. But in general, as an investment team, I like agriculture. And I still like resources and resource-related shares. And I'm more interested now in some commodities than in equities.
And also, what's the sense that you're getting on the commodity space? Are you as bearish on the commodities? Are you expecting correction in that space as well?
Commodities, having risen very strongly, will probably also correct on the downside. But I don't see new lows in the CRB index, which declined from a peak in July 2008 from 473 to less than 200. I don't think we'll go and make new lows. And I'd like to point out that it's very difficult to develop new oil fields and new copper mines, and that there is a genuine kind of a shortage of some commodities. And so each commodity has to be looked at separately. But there are two commodities that strike me as being very inexpensive. One is obviously natural gas, not suggesting that natural gas will go up immediately, but I think we are reaching a major low in natural gas, and I think also hogs are getting into a buying range. On the other hand, one of our prime recommendations, which was sugar, I think is getting pricey. I think it may still go up, but it's not a commodity I would now go and buy.
All right, Dr. Faber, one last question before we let you go. We've talked about equities, we've talked about commodities, the other asset class, fixed income. There are those who are saying that at this time, perhaps fixed income also gives you a decent place to park your money. Would you look at that, even if it's on the corporate fixed income side rather than the government fixed income?
I'm not particularly interested in fixed income securities, although I own quite a lot of corporate bonds, which I bought over the winter months because at that time credit spreads were very wide. Now they narrowed, and so I don't think that the bond market is terribly attractive. I think in general we are in a period where volatility will increase, and where maybe it's better to take small positions and stand on the side and look at new investment opportunities when they will arise.